Welcome back. Today we're going to talk about June private performance, the investments that we hold for our clients. Um, just kind of quick recap of the investments we typically use with our clients now is Blackstone's REIT, Nuveen's Global City REIT, Blackstone Credit, Carlyle Tactical Credit, iDirect Private Market Fund, BlackRock's Private Investment Fund, and Priority Income Fund. So of these funds, most of these are related toward generating income or being a non-correlated investment. So, kind of bunking, I know we're into September now. That's kind of one of the things with private investments. It takes a little while for the performance to come through those investments and those to be actually reported. So kind of go back to what was happening in June. S&P 500 was up over 3%. NASDAQ was up over 6%. So really good months from the public markets. The ag was even up a little bit on the month, almost 1%. Now, obviously, from June, we've had a lot of market volatility from that standpoint, but that's one of the reasons why we have these types of investments to kind of protect versus that market volatility. But really, let's jump into the performance because really that's what this video is all about. So Blackstone's private credit REIT up slightly in June, year to date up 2.37%. Nuveen's Global City REIT up 0.43% in June, now up 0.74 on the year. Both of these annualized dividend rate, depending whether we're using this for clients, where we're actually turning on this dividend, or we're just using it as a non-correlated building piece of our portfolio, really kind of depends on the situation. But if we're using this for income, again, one of the great advantages of these private REITs is these dividends can be tax-free. So if these investments live inside of a taxable account or an individual account, with Nuveen, their dividend is 100% tax-free, so it's 5.62% is tax-free inside of an individual account. And the Blackstone REIT, that 4.7% is 85% tax-free. So, as it comes to retirement or any other point where we're turning on this income, that's a huge, huge tax advantage for any investors. Now, that doesn't hold true if these types of investments live in an IRA or Roth IRA, because the taxable moment within those accounts is when it leaves those accounts, when it leaves the IRA, when it leaves the Roth IRA. So you don't have that same advantage there. So really where I'd like to see these types of investments is if we can put them in an individual account, that is going to be the best tax advantage with these types of investments. But again, whether we have taxable funds that we can use or qualified funds like IRAs or Roth IRAs, we still like these investments for the long term and the non-correlated part when markets aren't moving the way we think they should. These REITs should always kind of be a steady eddy part of the portfolio. Blackstone Private Credit, Carlyle Tactical Credit, and then the Priority Income Fund. Again, based on their dividends, these are big income producing pieces of the portfolio. If we're turning on those income pieces, again, great dividends, 10.3, 10.06, 12.35. But even if we're not in the retirement phase or income phase, and we're using this again as a non-correlated, we're rolling these dividends back into these investments every single month. But how did they do in June? Blackstone's private credit was up 1%, Carlyle up 0.69, Priority Income Fund was down a little bit in June. For the year, Blackstone's up 6%, Carlyle's just trailing that a little bit, and then Priority Income is about half that at this point. On the equity side, iDirect's fund was up 0.65 in June. BlackRock's was up 0.43 in June, and both of them above 4% on the year. Again, the reason why we have these equity type investments is over market terms, we should beat the public markets. But the big advantage with these types of funds is they don't essentially move very much month to month. So, as the equity markets have gotten very volatile over the last couple of months, when you check your statements every single month, these should be either small gains or even maybe a small loss, but you're not going to get that volatility. And then over time, we actually expect from a performance standpoint to actually beat the public markets. That's kind of the whole point with these. But in the short term, the volatility decrease is really what we get that from these funds. So anyway, I hope this was helpful. If you have any questions, please feel free to jump to